In this session, let's understand how to design optimum capital structure. Because we know what is capital structure, we know what is capital structure mix and what are the factors that goes into, but how you should design. Because capital structure can be a combination of debt and equity, but what do we mean by designing optimum capital structure? Let me show here. See, you know that you can raise funds for business through equity. You can also raise funds for the business through debt. Okay. But what you have to understand is when you raise funds for the business through equity, this is the costliest fund because equity shareholders, they have a lot of expectations. They are taking huge risk in investing in your business. Okay. So their expectations will always be costly. But if you are going to raise funds from debt, it is considered as cheapest. Why? Because they are going to have terms which will take care of their interest. And what will be the terms? The terms would say that whether your business makes profit or suffer loss, you have to pay them interest, you have to repay the principal. And what will happen if you don't pay? Of course, they will have some securities. They'll take their securities, they'll sell them, they get back their money. So their interest is always protected, and it is only because of that reason debt is considered as cheapest. Apart from that, there is one more reason. There is going to be a tax benefit. So tax benefit also ensures your debt is cheapest. So when you raise equity and when you raise debt, you should have appropriate debt equity mix. Okay. And for understanding what is appropriate debt equity mix, you should understand what is known as operating leverage and financial leverage. That of course I'll be explaining to you in the subsequent sessions. But one point, please keep in mind, if the market is doing well, let's say market is growing year after year, okay? If market is doing well, then you need more funds in the business because market is actually growing. When the market is growing, you should also grow. And if you want to grow, you need more funds. If you need more funds and if you can raise more funds, okay, in the form of debt, I'll put it like this. Market is doing well, so your business needs more fund. You can raise more funds in the form of debt. And if you are raising more funds in the form of debt when the market is doing well, then you will end up making more profit. You will end up making more profit. The reason is when the market is doing well, debt carries only the fixed cost. Okay, your cost is going to be fixed, but your sales will keep on be increasing, so you will have disproportionate increase in your profit. So you have the capability to make more profit. So this will contribute to higher EPS, and higher EPS, all these are going to function or work only when the market is doing well. That is, only things will work in good times. Okay. But let's just imagine the market is on the versus side. Okay, the market is not doing well. Market is facing a downfall. Okay, then in those times, if you are going to have debt in your capital structure, okay, in those times, if you are going to have debt in your capital structure, then this interest commitment during bad times will become the burden. It will affect the profit of the business and it eventually reduces the EPS. I told you, you have to keep the objective of capital structuring always in mind. Okay, what is the objective? Number one, the cost should be less. Number two, EPS should be maximum. Okay, in good times, if you are going to carry debt, you will make more profit, so you can have high EPS. But in bad times, if you are going to carry debt, interest commitment by itself will become a burden and it will directly hit your EPS. So what you have to do is, you have to check how your market is doing. If your market is doing well, okay, I'll put it like this. If your market is on growth path, okay, your capital structure can have more of debt. Okay, you can have more of debt. And if the market is not doing well, okay, if the market is not doing well, then your capital structure should have less debt. Why I am saying this? For the reasons explained. Okay, when the market is doing well, more debt means less expense, more profit. And when the market is not doing well, more debt means more burden, so less profit. Okay, so you have to take suitable care, and that's what focus of optimum capital structure revolves around. I mean, when I say optimum capital structure, it is not confined to the company, rather it is confined to the market condition. Okay, if market is doing well, try to follow this. If the market is not doing well, then you should understand this. You will get into burden, so you should not have debt in your capital structure.
Thank you for watching this video. Hope you liked it. If you wish to learn more on this topic, do check our comprehensive online course. I have given the link in the description below. If you like this video lecture, do not forget to click on that like, share and subscribe button with bell icon.